Three-day winning streak on the S&P 500, about 20 seconds away from the opening bell. Equity futures just a little bit softer, negative by 0.3%. Tons of earnings out there, disappointments for the likes of Tesla, Netflix. We'll get into that in a moment. The Nasdaq is negative about 0.8%. There's the opening bell. Switch on the board and get to the bond market. Earlier this morning, about an hour ago, jobless claims, the right kind of downside surprise. Yields up 6 basis points. A week yesterday for a Fed decision, looking for another hike in July and looking for guidance on what they might do beyond that in September. Your 10-year 380.90, your 2-year up 7 basis points to 484. In the FX market, just a touch of dollar strength. We break 112 on the euro, a week away from an ECB decision. 111.86 with negative 0.1% there, and crude just a break of 76, almost up 0.8%, up 60 cents on the session on WTI. We're about 30 seconds into this, we're negative 0.2% on the S&P, a whole lot more negative on the Nasdaq. The one stock to watch at the open is Netflix, under pressure after projecting a weaker than expected outlook. The company writing to shareholders, we have more work to do to re-accelerate our growth. Abby has more. Hey, Abby.
Hey, John. And what makes that interesting is that case could be true ahead of the quarter, because going into the quarter, you had the company looking at revenue growth for this year of mid-single digits. Right now, 7.1% revenue growth on the year. The stock up 60%. That's why you have this stock heading to its worst day of the year. It was priced for perfection. Investors simply did not get it. Now, what was interesting, because of the password crackdown, subscribers really surged, but it didn't equal big revenue. There was a little bit of a revenue miss, and the revenue guide is disappointing. So that's what investors are really weighing in on this stock. Now, Morgan Stanley does expect Netflix to deliver on its year-end target to re-accelerate that revenue growth by double digits for the fourth quarter. So that's pretty aggressive. They do have their work cut out for them. They will have to translate some of those ad subscribers to fully paid subscribers. One point of agreement on the street is exactly that, in fact, that the password crackdown has not equaled that yet. One positive, though, John, is the profitability for this company. They did have put up 22% margins. They also posted $5 billion in free cash flow. So it's not all negative, but investors right now, with this stock down 6.4%, really focused on the fact that they want the revenue to come from the password crackdown.
Abby, thank you. More on this story a little bit later. Mandeep Singh joining us on the program. Let's turn to Tesla. The automaker warning of more hits to its shrinking profitability. Elon Musk downplaying margin concerns and saying this: it makes sense to sacrifice margins in favor of making more vehicles because we think in the not too distant future they will have a dramatic valuation increase. David Welch joins us now for more. David, the stock is down by 4%. Can you explain what Elon Musk meant by that?
Well, I think if you look at the vehicle market, it's relatively strong. There's still not a lot of inventory out there, so people are still looking for cars. Maybe he's just generally looking at the strength of the consumer and that people will be buying vehicles and that they're not going to have to do as much discounting. But it was honestly pretty vague. I don't think investors are really buying it, obviously, because the shares are down. And I think in the case here, there's sort of a sin of omission. The one thing that Tesla didn't say, which they've often said, is that they want to maintain industry best margins. Because the amount of margin slippage in the quarter wasn't bad. These were overall pretty good numbers. But investors are looking ahead, and Tesla's not committing to that the way they typically have. And I think investors are just saying, okay, if they're not committed to industry best margins, then profits are going to be under pressure going forward. And Elon's not really explaining how he's going to boost the value of these vehicles. Part of it is some of the software and things they want to put in these cars, but it's not really explained. Near-term investors are kind of thinking they'll put their money someplace else and wait to see how all of this shakes out.
Explains the weakness this morning. We're down 4%. You have to think about that relative to the gain so far year to date, though. Before that move, we were up by something like 135%. David, thank you. David Welch there on the latest. From autos to airlines, American Airlines reporting quarterly profits in line with expectations. The more modest outlook coming after a strong report from United. Isabel Lee has more. Hey, Isabel.
Hi, John. It's vacation season, so maybe this is timely. But yes, American Airlines shares are falling, down about 4%, as their quarterly profits were just in line with Wall Street's expectations. Adjusted earnings will be 85 to 95 cents in the next quarter. That's smack in line with the 90, that's actually above the 90-cent estimate. So it was a modest outlook that offered investors a reality check, and this came after United Airlines and Delta really offered strong reports. United came in with strong third quarter and full year earnings estimates. The company said it will earn more this quarter thanks to a travel rebound. Year to date, though, American, Delta, and airlines are seeing gains north of 40%. And overall, we're seeing a global recovery as travel rebounds. So people are expecting it to surpass 2019 levels. So we'll see how that plays out.
Massive gains year to date on those names. Isabel, thank you. We talk about big tech all the time, the dominance of these magnificent 7 stocks. Need to talk more about airlines. And for me, the story of the year, right here, the home builders in America, D.R. Horton, topping earnings estimates thanks to a tight housing market. The company's saying, quote, despite higher mortgage rates and inflationary pressures, our net sales orders increased as the supply of new and existing homes at affordable prices remains limited. Katie, I wouldn't say despite, I'd say because of mortgage rates. This is what they're doing.
This is what they're doing, and it was a beat and raise quarter for several factors when it comes to D.R. Horton. Of course, like you said, mortgage rates. We know that D.R. Horton has been using mortgage rate buy downs to make those houses more affordable. They said that doing that really cuts rates by about 1%, and also that shortage of U.S. existing homes has been a big boon for D.R. Horton. They said that fueled a 37% jump in purchase contracts to nearly 23,000. That is well above analyst estimates. And to tie it all together, D.R. Horton actually reported fewer deal cancellations in this quarter at 18%. That number was 24% a year earlier. You take a look at the shares, though, and it's pretty interesting. Right now, we're about flat. We actually dipped negative as the bell rang. We had been up as much as 8% in the pre-market. We are getting the call right now, getting some comments from executives. They did say that significant increases to mortgage rates would hurt margins. So maybe you're seeing some of that caution in the shares right now. I will note, though, that D.R. Horton is about $2 away from an all-time high, but even at these nearly record high levels, D.R. Horton has been underperforming the industry overall. The S&P index of home builders up nearly 56% this year. D.R. Horton currently about 48% higher in 2023.
What a run. Katie, thank you. No doubt Katie covering that a little bit later on this afternoon. Let's turn back to Tesla. Stocks lower by almost 4%. The automaker beating second quarter expectations, but the company warning about more hits to profit. Mizuho's Vijay Rakesh saying this: with a weaker consumer and higher rates, Tesla has been leveraging price to drive volume at the expense of profitability. While margins could remain a key concern for investors near term, we could see second half tailwinds from commodity and logistics cost declines. Vijay joins us right now. Vijay, just build on that if you can. What do you see going in their favor in the second half?
Yeah, thanks for having me on. I think as you look at the second half, obviously Q3, they did say there'd be a small slowdown in the production side, but we think that could be made up by the inventory that they have on hand. But going into the second half, obviously, if some of the cost declines on the logistics and the raw material side start to hold, that could continue to help them on the gross margin line. One key highlight I would say on the June quarter was despite almost 200 or 900 bips of pricing cost cuts or price cuts on their Model 3, Y, and S, etc., the gross margins for Tesla were down only 100 bips. That shows massive cost efficiencies that they're leveraging across their supply chain. So
that's been an area of huge improvement for them across the last several years, you could argue. Vijay, you mentioned inventory. Global inventory, a lot of people pointing out it's up to 16 days. Now, Vijay, I'm not deep in the weeds in the auto market like you are. Can you tell me how significant that is?
I think that you have to differentiate a little bit between, let's say, Tesla's own inventory at like 50,000 units, which is, is pretty small, versus the global auto inventory, which is definitely going up. I think that's more a function of some of the consumer taste moving from combustion engine to electric vehicles, but also, as you mentioned previously, high rates. It definitely becomes a drag on the consumer to having to pay these high loan rates while buying the vehicle. So that's definitely going to be a drag, we think, on the second half on the broader automotive market. But for EVs in specific, you have a lot of subsidies that are flowing through the system. At the same time, you have OEMs like Tesla trying a little bit more flexible with pricing to the consumer, so that should help.
Tons of subsidies, yet Vijay, at the same time, Ford cutting prices, inventory climbing at the likes of Tesla. There might be some people watching this, listening to it, Vijay, saying that maybe actually we've tested some of the limits of demand out there at the moment for some of these vehicles. What would you say back to that?
Yeah, I think there is still room to grow. I think if you look at the pricing on these Model 3 and Ys, they definitely come down, but it's putting a lot of pressure on the ecosystem. That's why you're seeing Ford, etc., which you do not cover, but seeing, their inventory spiking up, they're cutting pricing. But, let's not forget, if you look at Tesla, they're running 10% operating margins on a $100 billion annualized business. And that compares to many of the startup and legacy OEMs that are running electric vehicles at 30% negative operating margin. So there's a massive moat between what Tesla is running at scale versus you can characterize some of the other EV OEMs still at subscale, still ramping up. But that's a huge I would say a positive for Tesla. So
Vijay, thank you, buddy, for catching up with us on a busy morning for you. I know you've got a lot of calls to make, so thank you, sir. Vijay Rakesh there on Tesla. Tesla negative this morning by around about 4%. On the S&P 500, we're down about 0.1%. Stifel's Barry Bannister shifting his focus from big tech towards cyclicals, writing this: we continue to see the S&P 500 level at around 4,400 for the remainder of 2023, with cyclical value outperforming cyclical growth. This occurs as a result of rising real yields, pressuring PE valuations, and because 23 is conforming to our view of a slowdown without a recession. Barry Bannister joins us now for more. Barry, I'll say up front, you were constructive and right for 2023. Let's take it to the next place you want to go from here. Do you think the market cap weighted S&P 500 from here then is going to be challenged? And if so, can you give us the why?
Yeah, I think we're a few percent overvalued. I do think we end the year around 4,400 on the S&P 500. Since mid-year, we've been saying that one of the trades you could do was long equal-weighted, short cap-weighted S&P for a broadening of the market. The other, as you mentioned, is the cyclical value, and that's really banks, diversified financial services, industrials, basic materials, and some of the transports.
Barry, do you think that's a short-term tactical play through the summer? Heard a lot of people say there's a sweet spot here for disinflationary trends, or do you see it being somewhat more sustainable than that?
Well, policy works with a lag, and recessions tend to come as surprises. I do think the employment markets will weaken towards year-end. You've got corporate pricing power with a weak PPI, weakening inflation. You've got corporate pricing power falling below wage growth, and wage growth being fairly high is keeping the core PCE ex housing, which is called super core inflation, above what the Fed's comfortable with. So if the Fed is not willing to accept that the normal run rate for inflation going forward with positive goods prices and strong services demand is going to be closer to 3% at the core level, and they're still talking 2%, then they're going to stay tighter for longer, and eventually that'll weigh on the market into 2024.
Do you think, Barry, that's a September time story? That until then we're in this nice spot and equities can do nicely?
Well, we've both been doing this long enough to know that September, October are treacherous months for the market. So if there's going to be any pullback towards this 4,400, it would probably be at the end of the summer and into the early fall. And as we conclude the year, though, we do think employment markets will weaken. And once they weaken just a little bit, it won't take much. It would be a pre-recessionary signal. We would know that at some point in 24, a recession, however mild, was coming. And one thing I would throw out there, Jonathan, is I'm pretty bullish on oil prices from the supply constriction side. I actually think we're going to have a mini oil shock in 2024. And when that happens, on top of unemployment, you could see a lot of tumult on the interpretations from Washington of what's going on.
Barry, just out of interest, are you positioned for that now? How would you suggest someone positions for that out on the horizon out in 2024?
No, I mean, everything is a rental now. Everything is a trade. If you think back to 2022, utilities, energy, they were great. Then they were terrible in the first half. Tech was terrible last year. This year it was great in the first half. The cyclicals, the banks, they were terrible in the first half. Now they're going to be good. You really can't get too far ahead of yourself and over your skis when you're investing in this kind of a market. We are not in a buy and hold 10-year long double-digit bull market anymore. We have to be very tactical in how we trade this thing.
Well, let's focus on a tactical trade then, Barry. Just a final question from me. What are you telling clients? Do you do this through a single name, through a sector, through an equal weight index on the S&P? What are you suggesting?
You know, like I said, it's heresy for a broker to say this, but there are ETFs to trade everything. And so if you were long RSP, the equal weighted S&P, and short SPY, that's the long equal weight, short cap weighted. The other is if you buy the KBW Bank Index. KBW is a subsidiary of Stifel, KBE on the ETF. You can participate this in multiple ways. There are sector spiders and industry spiders at BlackRock that are perfectly good for trading just the names of industries that we just listed.
Barry, appreciate your time today. And again, great call so far year to date. It's interesting to see you make a change in the last month or so. Barry Bannister there of Stifel on the equity market. Just making a tactical call for this market to broaden out away from the dominance of big cap tech, but ultimately putting a time limit on it and then raising a flag potentially on a risk around energy for next year. Fascinating stuff. 15 minutes in, we are just a little softer by 0.1% on the S&P. On the Nasdaq, that's where your underperformance is this morning, and this is where it is at a single name level too. Coming up, Netflix delivering a disappointing outlook.
Listen, Netflix is winning the streaming wars. There'll be some consolidation. Pricing will be raised by the others, and marketing costs will come down, and they'll eventually turn profitable. But Netflix clearly has the lead and will be the long-term winner.
That conversation up next.
only a small percentage of our members are on the ads tier, even with the moves we just mentioned. Nice growth in the ads tier, but still off a small base. And we're really early in terms of paid sharing impacts, including extra member, for the reasons that Greg mentioned. That's going to build up over multiple quarters.
Netflix CFO Spencer Newman weighing in on the earnings call. The stock heading for its biggest drop of the year after delivering a disappointing outlook. The company writing this: while we've made steady progress this year, we have more work to do to re-accelerate our growth. Geetha Raghunathan of Bloomberg Intelligence joins us right now. Geetha, this is the $195 billion question this morning. How do you beat subs by as much as they did and then come in light on revenue? What happened?
Yeah, that's really puzzling. So, I think what happened was obviously their paid sharing crackdown, or their password crackdown, kind of went into effect. It looks like that was obviously a success because, you did have that big, it did spark that increase in subscribers. I think what has happened, though, over the past few months is Netflix has actually cut prices in many international markets in order to kind of reinvigorate that subscriber growth. I think that's what we saw kind of flowing into the ARPU a little bit, as well as I think what happened is Netflix was probably hoping that with that password crackdown, they would kind of really get it to be a catalyst for people signing on the cheaper ad plans. And remember, again, the ad plan, you're paying only about $7, $8 for subscription, but you're making up the rest through advertising, which kind of makes it equivalent to a standard plan with $15.50 in the U.S. I think what happened instead were maybe people started to sign up for the ad-free plan, which came in at about $10. And I think yesterday's move by Netflix to actually eliminate that plan, both in the U.S. and U.K., shows that they do want to kind of drive ARPU higher. So I think there's, different moving pieces here, lots to parse out, but I think maybe the revenue impact that they were hoping for obviously is going to flow in a little bit later than they had initially anticipated.
Geetha, do you think that's something you can achieve in one quarter? Does it take several quarters? How long do you think it would take for that to be successful?
So I think investors were definitely expecting. So Netflix itself has outlined this revenue target or reacceleration of revenue growth in the double-digit territory. Obviously, that's not happening in the third quarter since they guided to about 7.5% growth. However, I do think that, with all of the different initiatives in place, and as those effects of, password crackdown and the advertising-based plans kind of start to flow through, it will happen in the fourth quarter. So we actually think that, Netflix gets to that 10% growth in 4Q, and then we're definitely going to see a much bigger ramp up, I think, in revenue in 2024.
Just one final one, Geetha. I know you're super pressed this morning, but just on the strikes in Hollywood, did they flag that as a concern on the call at all?
They started the call with the strikes, and they said that they're really looking to kind of achieve an amicable solution as quickly as possible. They didn't want the strike. They wanted to get resolved as quickly as possible. But having said that, they are really not in as bad of a situation even with the strikes going on. In fact, it's actually going to boost their free cash flow. They boosted their guidance for free cash flow by about 40%. So yes, if it drags on, it will be a problem, but right now, no immediate financial impact.
I hear that from a lot of analysts, particularly relative to the competition. Geetha Raghunathan there of Bloomberg Intelligence. About 22 minutes in to the session, we're down 8% on that name. We're down about 0.1% on the S&P. Let's get you some sector price action. Here's Abby.
Based on that small loss, John, this is not intuitive, but most S&P 500 sectors are higher. But what we are looking at is that consumer discretionary drag down by Netflix, down 1.4%. We also have communication services and tech down. So that's really the heavyweights dragging on the index, whereas energy, healthcare, utilities, financials, staples, and industrials higher. As for the real estate sector, earlier you were talking with Katie about D.H. Horton. We had the real estate sector on the day or over the last few days down 1.8%. It's interesting because DHI all over the map, and SL Green, an office property owner here in New York, the biggest one, John, well, they reported disappointing outlook in terms of, or I should say, they just lower rents for the quarter that just was. That stock down, John.
Abby, thanks for the latest. That's some of the soft spots right now in the equity market. Your trading diary. Up next, the runway into the weekend. Snapping a three-day winning streak on the S&P 500. About 26 minutes into the session, we are negative by 0.07% on the Nasdaq. Your underperformance, we're down by about 0.5. That's the price action. Here's the trading diary. Existing home sales at the top of the hour. You'll hear from the president again at 1 p.m. Eastern on the economy. The Nasdaq's rebalancing happening over the next week, into next week. Tech earnings ramping up Tuesday with Alphabet, Microsoft and Snap. And finally, Fed rate decision. That's next Wednesday with a Chairman Powell news conference. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
At that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Thursday, July 20th. Here are the top market stories we are following for you at this hour. Tech trips. Netflix's disappointing sales view and Tesla's margin concerns send those stocks lower, taking the Nasdaq 100 down with them. Is this the market-leading rally meeting its end? But wait, there's more. The earnings movers don't stop there as United and American Airlines up their outlooks, and J&J raises its guidance too. We'll be joined by the company's CFO, Joseph Wolk. And homing in on housing, existing home sales data is just dropping now. Plus, we'll get a read on the rental market with Scott Lawler, Waypoint Residential founder and CEO. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, the first tech reports out of the gate were disappointing, but also disappointing the economic data that just crossed the wire.
This is a broken market, Kaylee. I'm almost at the point where I don't even think we should look at it. Existing home sales come in a little light, 4.16. The expectation was 4.2. That's down from 4.3. Who cares? This is a market that previously had a run rate of 5.5 before the pandemic. Low rates mean that people aren't moving. This market is broken, but what is bad for existing home sales is good for new home sales. That market is absolutely roaring right now. I know you don't want to talk about the housing market, but that market in particular is doing very well. So yeah, a little bit of a miss, but if you're looking at existing home sales for a signal on the economy, you ain't going to get it.
Yeah, it's a very good point. The 3.3% drop we saw month over month was a bit more sizable than the 2.3% drop economists were looking for. But you make a very good point, Guy. And of course, there is the rate sensitivity question here. And we saw that showing up as well in Tesla's results, right? Elon Musk saying they're going to have to keep cutting prices so long as interest rates keep going higher. It is an interest rate story.
It is. It's a margin story. It's a manufacturing story. There's a whole bunch of factors in here as well, Kaylee. And I think it's fascinating. Look, the tech sector has roared this year. We know this. It is absolutely flowing. You look at Netflix, you look at Tesla. We're going to see more of them next Tuesday. The story's been sensational so far this year. So we talk about tech tripping. Wow, what a run it has had. It's been running at full pace. Yes, it stumbled a little bit, but shouldn't we expected it to? The Netflix story I find sensational. The stock is down pretty hard. Revenue didn't come this quarter, but if you look through the numbers, looks like it could come next quarter.
All right, well, let's look through it some more and get more on those disappointing results from both Netflix and Tesla. Bloomberg Technology co-anchor Caroline Hyde is joining us now, I'm glad to say. So, Caroline, let's begin with Netflix, down 8%. Is this just a case of expectations, the bar being too high?
And the fact that they're just not making money on something that they've executed pretty well. The fact that they've cracked down on password sharing, the fact that they are introducing this new advertising tier, but the money isn't flowing in from it yet. And as you guys were just articulating, this stock has roared. It is up 170% from its lows of last year. It's up 50% on the year. It's the second best performer on the NASDAQ. So no wonder perhaps you get a little bit of profit taking. The shares sinking today, the most since we've seen since December. So this is still a company that continues to execute. And in fact, Bloomberg Intelligence saying from a long-term perspective, this is a company you still want to be betting on. It's just in the here and the now, perhaps the revenue isn't quite being generated in the way we anticipated.
But it could come next quarter, and it's similar with Tesla, isn't it? There's a lot down the road. This is a company that is constantly transforming. Netflix looks the same. I was listening to Geeta just a moment ago talking to John. She's basically saying that what has happened is that the subs push, the password sharing push has led to people going onto the lower price point rather than going for the advertising tier. They've gone for the lower price point, which is a price point they're now going to get rid of because they make more money on the higher price point or the advertising, so they're going to cut the middle. So revenue comes next quarter. It's just we just got to wait a little bit longer. The market reaction is brutal, but I guess you should expect it.
Yeah, and actually, credit where credit's due, they added more than 5 million subscriptions, far more than the market had been anticipating. Yep. And also, I think Geeta was writing very well in Bloomberg Intelligence about perhaps that they're really gaining traction in developing countries. Well, you pay less, therefore there's less average revenue per user out there. We're really trying to focus on the developed countries where we already know that perhaps the tipping point has been hit in terms of where we're at, the amount of, well, online subscriptions we already want here in the UK and the US.
Okay, so that's the Netflix story, Caroline. Just quickly on Tesla, because it's getting hit as well, now down 6%. It's all about margins. How much more realistically can they give?
Well, 18.1% is still very healthy compared to other automakers, but it is just perhaps starting to dial back. People wanted to see that margin recovery, but I'm afraid Elon is still very focused, as we all knew he was, on getting up volumes, and to that he has to sacrifice profits. It's also notable that perhaps what spooked the market was this focus on the supercomputer, on Dojo, on the fact that this is a buy on autonomous vehicles. This is an investment in AI, on the fact that you'll get robo-taxis. This is Kathy Wood's, of course, key focus on why this company's got such a long-term trajectory, but it's going to cost on R&D, on OPEX right here, right now. And in fact, the CFO tried to calm nerves and say, look, this was already factored into our 3-year perspective, but that 1 billion figure for the next year on that Dojo supercomputer, it just shows that we're still having to invest in AI, in the Cybertruck that's coming later than expected. And for now, well, if you're going to get that inventory, which is now up to 16 days of cars in inventory rather than the 4 days that we had last year, you can get them sold, you have to cut prices.
Caroline's going to get into all of this in much more detail. Bloomberg Technology coming up a little bit later on. Looking forward to the show, Caroline. Thank you very much indeed. Caroline giving us an early look at what is happening with these tech stocks. Let's carry on the conversation now. Is tech's time up? Tech has certainly tripped overnight, but is it a long-term story? Laurie Calvasina, RBC Capital Markets Head of U.S. Equity Strategy, joining us now. Laurie, great to see you. What do you make of the market reaction to what we got from these two companies?
So first of all, thanks for having me. And I think it's really interesting. I love the phrasing you used, Guy, of tech has tripped. And we are seeing some decent sized reactions today. But one of the things we had talked about coming into this reporting season was that positioning in big cap tech generally was starting at least tactically to look a little bit stretched if you look at the CFTC data on asset manager positioning in NASDAQ futures. And if you also looked at earnings sentiment in the growth trade versus the value trade, we were starting to get concerned that growth stocks had hit their kind of peak excitement around earnings. And what I mean by that is the rate of upward revisions. It's a good gauge of earnings sentiment. It's been much, much stronger in growth than value so far this year. And it's been that gap between the two has been about where it tends to peak out. So one of our big questions coming into this reporting season is that earnings enthusiasm around growth going to fade a little bit and improve on the value side? And could that facilitate a leadership shift in the market?
Well, to that exact point, Laurie, if tech can't lead or is no longer going to lead, what will?
So you have to look, I think, at the cyclical parts of the market. If you look at defensives, they're generally pretty rich right now. If you look at things like consumer staples and utilities, and the zeitgeist in the market at the moment is actually buying more into the idea of a recovery economically in 2024 or a skipped recession. So I don't think you want to look at defensives for leadership right now. And that leaves you with the cyclicals, things like financials, industrials, or energy. Those are all having pretty good days. At least they were right after the open. And the financials, it's still very early in that reporting season, but so far it seems like a pretty decent kind of solid tone. I wouldn't say it's fantastic, but the headlines feel pretty decent to me so far.
Laurie, do you think the equity market is now completely on board with the idea that inflation is beaten, that the Fed has got it under control? And what if that's not the case? What if inflation reaccelerates after the summer? What if the Fed has more work to do?
Well, look, I think that latter scenario is a big risk. One of the data points we've talked about a lot, the analogy between 2023 is 1945. And if you look back at 1945, we had a transition out of a wartime economy to a peacetime economy. There was disruption in the labor market, big withdrawal of government support, and inflation, which had been a big problem in preceding years, actually moderated a bit. But then you went on into 1946 and inflation came back. We had another decline in real GDP and the market ended up falling 12%. So I think even that kind of wartime economy analogy gives you some reason to stay vigilant about inflation. But for now, I think all the data is headed in the right direction. We don't really, I think, have a big reason to fear that 1946 scenario yet, even though we do have to monitor it. Our economists have a heat map on inflation that they put out, and the way they've been describing it recently is there's a lot of green on the screen. A lot of the important categories are headed in the right direction, as well as the overall numbers.
Well, when we talk about that direction, which would be inflation heading down and the labor market not meaningfully heading down, Laurie, it has built this kind of soft landing chorus, if you will, of people having that now as their view. I just wonder if the equity market is too optimistic about what a soft landing perhaps means, if it means actually that rates stay higher for longer, because if the landing is soft, why does the Fed need to turn around and start cutting?
I think that it translates into what kind of multiple you're willing to pay and what that earnings growth looks like. And when, we have all this quantitative modeling that we do to try to come up with S&P 500 targets. We're a little bit above my target right now. But the most bullish scenario that we have is our valuation and earnings test. Our earnings expectation is 219 right now. That's right in line with the consensus. But we have a much higher multiple assumption in the low 21 type area. And we've been consistently seeing that with, an elevated Fed funds rate, that you can still justify a low 20s kind of PE multiple. And if you do the math with our 21 and change PE multiple, our 219 earnings, that can put you into kind of the 4,700 range on the S&P at the end of the year. So I don't think that where we are right now is too optimistic necessarily. I do think we have other problems brewing in terms of sentiment, but if you're just thinking about kind of moderating inflation and the impact that can have on multiples, we're kind of trading about where we deserve to be, and you can make the argument that we could go a little bit higher as well.
Laurie, a lot of people have got money in money market accounts right now. They're trying to figure out how to re-enter the market. What do you say to them? How should that process unfold?
So look, I mean, I'm an equity strategist, right? So I always want you to be involved in equities precisely because of what's just happened. People are really bad at timing bottoms and getting in on recoveries. And recoveries, off of extreme fear are often doubted on the way up. And that feels exactly like what we're in at the moment. So what I would tell you is that on tech, we started that at the top of the interview. What's sort of the case for tech? I think tactically it's got some problems, but longer term, I do think the economy is still going to be sluggish. Projections for 2024 and 2025 are at 2% or less, and typically growth stocks do better in that environment. So if we do get some weakness on tech in the short term, I think you could opportunistically add to positions. We are still overweight there. We're not pulling that off. But I would say, if you want to sort of balance the short term and the longer term, you do need to look at things like energy. You need to look at things like financials, where the baby was kind of thrown out with the bathwater in recent months. Those are areas that typically do very well when the market is having recession recovery trades, and they're both quite cheap. Earnings revisions have been weak, but we think at least with financials, we're starting to see hints that that's turning around. So I think you've got both short-term and longer-term opportunity there.
All right. Well, I wish we had a longer term to speak with you today, Lori, but we got to leave it there. Thank you so much for joining us, Lori Calvasina of RBC Capital Markets. Now, coming up, pent-up demand for medical procedures has helped driving Johnson & Johnson's profits and the stock. We'll have more on those results with the company's CFO, Joseph Wolk, next. This is Bloomberg. Johnson & Johnson was out with results today. It's the first large U.S. drug maker to report second quarter earnings. The stock getting nicely rewarded for that report. Bloomberg's Simone Foxman has the details. Simone?
Yeah, indeed. Kaylee, shares of Johnson & Johnson quite a fair bit higher today after it boosted its adjusted earnings forecast by 10 cents a share for the year. Also saw strong pharmaceutical sales. That is its main segment. They came in at $13.7 billion. That's a fair bit above estimates. But what was really interesting to me was what happened in the medical technology sector. Because one of the things we've heard, especially from insurers recently, has been that a lot of people, they're taking advantage of the fact that COVID-19 pandemic is largely behind us. They're going and getting all those elective procedures that they put off. And as you can see, looking forward, the estimates for 2023, 2024 revenue from this segment are very high. We saw a pretty good result there as well, up 13% to $7.8 billion. A couple things that analysts are going to be looking for and the things they were asking about in the earnings call today. One, the spinoff of Kenvue, that is the consumer healthcare division. The announcement today coming that a exchange offer to finalize, to move forward with that spinoff could come in the coming days. Also going to be watching Stelara, one of J&J's key drugs, may get a competitor in the U.S. market, but if it doesn't, that will be incredibly positive for the share price. We are still down a fair bit from where we were, not just at the start of the year, but 2022, but of course seeing a reversal of some of those declines today. Kaylee, Guy?
Simone, great stuff. Thank you very much indeed. Perfect setup. Let's talk more about what is happening with this company and try and answer some of those questions. Johnson & Johnson's CFO, Joseph Wolk, joining us now. Great to catch up as ever on the numbers, Joseph. Look, I have to say the market likes what it's heard. We're seeing a decent share price reaction. The stock is up circa 5% right now. The market likes in particular the outlook, likes what it's seeing in terms of what the company is going to deliver further down the road. I have to say I looked at the numbers, Joseph, and I wondered whether you could actually have been a little less cautious. I'm looking at these numbers and thinking, are you just being, as you always are, J&J, a little bit cautious and conservative, or is there something down the road that you're kind of a little worried about? Could you have been more optimistic, do you think, in that outlook?
Yeah, good morning, guys. Great to be here with you and Kaylee. I would say it's a little bit misleading, and there's much more that meets the eye. We're so pleased with the performance of the business. And if you might recall, when we had this conversation in January, we had a qualifier of, hey, we're going to be responsibly cautious. We changed to, responsibly optimistic in the in the April call, and now the qualifiers are off. We're seeing such strength across our business, and I'm so pleased that it's really the combination of products like Darzalex and Tremfya, products that have been around for a while and have been great contributors, still growing at 20%, but now we have some new entrants, two specifically for multiple myeloma and Carvykti and Tecvayli, and then one in neuroscience. We all came out of the pandemic having a better appreciation for just how much mental health was a factor in society. We've got a great drug known as Spravato for treatment-resistant depression that's doing tremendously well. On the medtech side, we have new catheters that are performing extremely well in electrophysiology for heart arrhythmia. We've got the Velis knee replacement system for surgical robots, and then a great contact lens with Oasis Max. So you've got new products and older products doing what they do, which is really not only positive for the balance of this year, but really into the balance of the decade. So we're very well positioned. In terms of your question about were we too conservative, if you look at the EPS raise of 10 cents, it's really a little bit misleading and more than meets the eye, because we've taken two, I would say, discrete but strategic items that were not accretive to EPS. One being the non-controlling interest related to our ownership in Kenvue of 10% currently. And then there's a second investment that we made to fortify that long-term pipeline, getting further into cell therapy for B-cell malignancies. Most of our competitors actually take guidance down for that. Our business was strong enough to absorb it. So it's really a 28-cent operational outlook improvement, but there's 18 cents of, I'll call it, headwind there.
Well, talking about that Kenvue spinoff, Joseph, good morning. It's Kaylee in Washington. How is that going to change your role as the CFO, and how should that change how analysts view this company?
Yeah, I think when we announced the separation, we really did it for strategic reasons. If you think about the criteria for success going forward, med tech, pharmaceuticals, heavily regulated, it requires heavy R&D investment, and there's long timelines for development. Compare that and contrast that to what's evolved in the consumer health segment, where it's much more social media interactive, there's more personal choice. Our investments of years past of getting 9 out of 10 dermatologists or 9 out of 10 dentists is now replaced by getting a celebrity personality. So it just became different criteria for success going forward, but it really doesn't change the strength and breadth of Johnson & Johnson that will remain. We still have 25 platforms that will generate by themselves each at least $1 billion in revenue. So we're a highly diversified, the most broadly based healthcare company even after the separation.
Joseph, there are a few clouds on the horizon. Talc is obviously one of the issues that you're dealing with right now. We've seen recent litigation, obviously maybe working against you. Talk to me about how you think the market is valuing that risk? Do you think the market has got its arms around that? Do you think it's properly valuing that risk in your business right now? What kind of a discount do you think is being applied?
Yeah, it's a hard question to answer, Guy, and we've been trying to address that for a few years. I would say of the news this week, we were highly disappointed in the verdict in California. But the headlines you typically don't see is, and it happens very, very often, is when we went on appeal. And we certainly plan to appeal in this case because we believe that the trial court judge really prevented evidence from being shown to the jury that is scientifically and factually critical. To be clear, it does not impact the LTL bankruptcy proceedings, which are ongoing, and we expect some milestones next month. So we'll see how that plays out. If we have to go back to the tort system, we're certainly prepared to do that with the great defense of 40 years of clinical independent data that proves the product is safe, does not cause cancer. And we're also going to have to elevate or escalate our offense as well, highlighting some of the, I would say, misgivings of the tort system as they currently exist, where plaintiffs' attorneys can venue shop, they can coordinate financing through private equity to prop up this type of litigation, and even put so-called experts on the stand that have fabricated conclusions.
Joseph, speaking of litigation, J&J recently joined with others in suing regarding the implications of the Inflation Reduction Act. What realistically are you hoping to achieve with that?
Yeah, so we joined the Chamber of Commerce as well as other industry peers to really object to the real assault on innovation. Life science is one of the leading industries for the U.S. And what they're looking at doing, especially around small molecules, is limiting patent protection from 14 years down to 9 years. It takes on average, Kaylee, about 7 years to develop a drug. So 2 years after launch, the government is going to go in and price set. It's not a negotiation, it's setting prices. There's a recent report that's out that says 85% of Americans have access to new medicines when they're available. That should be 100%, quite frankly. But you contrast that to countries like France and Canada that do set prices, that access drops to 43% and 21%. So from a financial perspective, I'm a little, I guess, quizzical on how it's going to reduce inflation, because we just published a transparency report on our pharmaceutical pricing, and it dropped 3.5% in 2022. When we were going to the gas station to fill up our tank or buy groceries, paying 10, 15% or more for products and services, pharmaceuticals actually went down. And while I referenced Johnson & Johnson's numbers, that's really representative of the industry. 6 consecutive years now, our price has gone down.
All right, well, definitely an interesting conversation for us here in Washington. Joseph Wolk, Johnson & Johnson CFO, appreciate the time. Thank you very much. This is Bloomberg. The losses are building for tech stocks. The NASDAQ 100 is now down more than 1% after twin disappointing results from Netflix and Tesla after the bell yesterday. Netflix, it is about the disappointing revenue view. Yes, they have more subscribers, but when is that going to convert into higher sales for the company? Certainly not converting into a higher move for the stock today. It is now down 8.4%. Tesla, for its part, down 6.4%. The concern there is margins. Meanwhile, in the bond market, interesting to see the two-year yield up 10 basis points. We did get initial jobless claims at a 2-month low. We're now at 487 almost, basically back to where we were before last week's CPI. But coming up, we're going to turn to Blackstone. We'll have an interview with John Gray next.
Authority.
We are an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, it certainly does not look good for tech this morning.
It really does not, Kelly. In fact, right across the board, we have some weakness. This feels like the worst down day in quite a few days, given the fact that we've had a melt up recently. The S&P 500 outperforming, down just 0.4%. But you can see, to your point, the tech weakness, that NASDAQ 100 down more than 1%, and the NYSE FANG index down 3%. The worst day for these tech indexes going back to June 26. So almost in a month. Now, one factor, of course, we do have yields backing up. In fact, the 2-year yield is now backing up 3 days in a row. At this point, up about 13 basis points over that time period, 486 or 87. This, of course, makes valuation look a little bit tighter on growth stocks, in particular big tech. However, as we all know, it has to do with two stocks in particular, Netflix and Tesla. Both companies reporting earnings. Netflix down 8.3%, its worst day of the year, after they put a blood blowout subscriber numbers on the password crackdown, but for some reason not translating to revenue quite yet. I haven't heard a great explanation of that. It's a little bit of a conundrum. And as for Tesla profitability and issues, so we showed this chart last week or the week before, and what we're looking at is the New York FANG index extended to a huge degree, 45% above its 200-day moving average. The RSI is moving out of overbought territory. The last time that we saw such an extreme situation, it was right before the pandemic. It could go a little bit higher. Sometimes these things go further, but this chart very clearly, very strongly suggests that we are likely to see some consolidation ahead for big tech guy.
Certainly seeing it today. Great chart, Abigail. Thank you very much indeed. Abigail Doolittle on the markets. One other company out with earnings today, and we really need to talk about this, is Blackstone. So profit has been slumping along with deals. That's an obvious kind of connection to make. Sonali Basak, who's having a very busy week, sat down with Jonathan Gray, Blackstone's president and COO.
This year, you had a lot of concern about where inflation was going, a lot of concern about how far the Fed would go. You had the banking crisis in March, and naturally you see a slowdown in deal activity. I think the good news is the tone has improved as we've worked through this quarter. The deal market feels like it's unfreezing a bit. If you look at our credit area, our direct lending, our pipeline is up more than double than where it was 90 days ago. So we're seeing more activity there, more activity in our tactical opportunities area where we help companies and investors by providing flexible capital. Our secondaries business is seeing more activity. So I think as people feel better about the overall picture, a little more certainty, I think we'll see deal volume pick up as we move forward.
Are the financing markets becoming open enough for you to do something big? At what time will we see Blackstone doing multi-billion-dollar deals, perhaps deals along with partners again at that scale?
Well, we've done a few large deals this year. We announced at the end of last year Emerson's climate technology business for $14 billion. We privatized Cvent, an online event management business, a multi-billion-dollar transaction. We're looking at a number of things of scale. Obviously, the financing markets make it a little bit trickier, and you've got to be creative in trying to pull transactions together. So this takes some time, but the good news is, as you point out, we've got $200 billion of dry powder, and that dry powder allows us to move when opportunities arise. I think we'll see more of those opportunities over the next year. It's hard to put our finger on it exactly when it'll happen, but I just feel across our platform there'll be some interesting things, and scale is a real advantage for us.
Let's talk about the macro environment for a second, John, because earlier you talked about uncertainty being kind of the killer of deal making here. Is some of that uncertainty clearing, particularly as it comes to inflation?
Yeah, I think the good news on inflation is it's trending down. The Fed is really winning this war. They're not ready to declare victory, but what we see in our portfolio companies is input costs really coming down now to less than 2%. We see wages, which were running higher than 7% mid last year, to growing at less than 5%. Forward indicators in hiring and vacancies are also positive. So the labor market is starting to soften. It's still pretty strong, but I think that's going to be helpful as the Fed looks forward. Now, what do I think happens? I think they're going to raise rates, it sounds like, one more time, and then they're going to hold them here for a longer period of time to try to slow the economy, and we expect they'll be successful in doing that. We don't think this is 08-09 in terms of a slowdown, but you do have to anticipate some slowing of economic activity, some increase in unemployment. But we have, at this point, gone through an inflation shock, we've gone through an interest rate shock, and now we've got a bit of an economic slowdown. But we're getting through this, and I think that's one of the reasons why we see some enthusiasm in the markets.
When people think about concerns still left about the economy, there's still a lot of concerns, and you see it in the write-downs already for certain companies when it comes to commercial real estate. I know that your portfolio, you've leaned out of office for a while now. How do you feel about the direction of travel for the property industry moving forward? What are the pitfalls that some investors might be falling into here?
Well, I think there continue to be big challenges in traditional office buildings in the U.S., particularly older buildings. Vacancy levels are very high. Rents are under pressure. But where you invest matters. So if you are deployed today in stronger areas like logistics and student housing, data centers, which we talked about, the fundamentals there are very strong. And geographically, obviously, some cities are under significant pressure. Let's use San Francisco as an example, and yet we see a lot of strength in Texas and Florida. And so where you invest, that is key. I think our team in real estate has done a terrific job. And then looking forward, the positives are rates are coming down, or at least are no longer going up at the short end like they were, and the long end seems to have stabilized, and that is helpful for commercial real estate values. Also, new supply is coming down, which is another positive when you think about commercial real estate. So both of those things give us some confidence as we look over the intermediate term.
Speaking of real estate also, there's a lot of news over the last couple of months here about BREIT. This is the product you have for retail investors, semi-liquid, tied to the real estate industry. Do you see withdrawal pressure starting to ease on that business?
Well, what we've seen here is a decline in share redemptions. They peaked in January. They're down nearly 30% at this point. That's obviously a positive sign. We've said we think it'll take time to work through the backlog, but the key is performance. And we've delivered 3 times the public REIT index over 6.5 years. We put the capital in what we think are the right places: logistics, rental housing, data centers in the Sun Belt. And ultimately, investors appreciate that performance. And I would just point out on the redemptions, if you were an investor who put in for a redemption at the end of November and you continued to do that, at this point you'd have more than 90% of your money back. So we feel good about the product and the way it's working for our investors.
That was Jonathan Gray, Blackstone President and COO, speaking with Shonali Bossack. And Shonali is joining us now. Great interview. Thank you so much for bringing that to us. Can we just talk about this big round number, $1 trillion? How significant is that?
Yeah, it's a very significant number, and everything that comes along with it. Remember, Blackstone has more than 230 companies that it is invested in, 12,000 real estate assets, and it's incredible. You know, this idea of them hitting $1 trillion, it's not just the assets under management. The market capitalization of Blackstone today is almost $10 billion more than Goldman Sachs. So you have the private asset giants that have just ballooned very meaningfully. The stock price is keeping up with them. If you take a look at the 5-year stock prices for Blackstone, Apollo, KKR, over 5 years, it's more than 100%. And you are not getting anywhere near 100% for any of the big 6 banks over that time frame. And so you've seen this very significant move of investor interest over to the likes of Blackstone relative to JP Morgan and Goldman Sachs. As you can see here, just how much that differential, and it has only gotten wider, that differential, since the pandemic, which shows you just how much investors have been clamoring over private assets, private credit, private real estate, as movement has moved away from the banks.
So when Jamie Dimon talks about non-banks dancing in the street, he's basically talking about the fact that Jonathan Gray has got his dancing shoes on. Is that what we're talking about here?
Yeah, Jamie Dimon named Blackstone Apollo by name when he made that comment. And when I actually asked John Gray about it, I said, are you dancing in the streets? And listen, he was very cautious about how he answered. He answered in a way that kind of said, listen, that we work in conjunction with the banks. He doesn't want to make it seem like a lot of his rivals that they're just taking all the share away from the banks when they still work so closely with the banks. But with that said, we are seeing not just with the big banks being competitors on underwriting. He also mentioned his private credit arm had a significant backlog when they're looking at future deal activity, which means they're underwriting new deals just as much as these banks are and showing underwriting fees coming back. And that means they're also competing with regional banks more and more as we kind of get to the second phase, or partnering rather with the regional banks as they look for ways to bring more capital into the economy. But listen, guys, it doesn't come without scrutiny. There is an acknowledgement here that this is a big regulated industry, and you get past $1 trillion and the eyes are on you, could mean more regulation moving forward.
Shonali, it's Thursday, it's nearly Friday. You've had quite the week. It's been incredible. Friday is coming. Shonali Bossack, another fantastic interview. Thank you very much indeed. Coming up, U.S. home resales falling to a 5-month low. More on the state of the U.S. housing market. Scott Lawler, founder and CEO of real estate investment firm Waypoint Residential, is coming up next. This is Bloomberg.
Let's turn back to the housing market. We saw with data at the top of the hour that existing home sales dropped in June. Low inventory is limiting sales. Natalia Knievich breaks down the numbers for us. Natalia, go ahead.
So numbers are going down. Existing home sales dropped 3.3% in June to 4.16 million units. Just to compare, in May, the number was at 3.4 million units. And overall, if we look at the big picture, the number is down by more than 35% from its peak in 2021. Rates are higher, inventories are tight, and also as we move into the summer, usually sales slow down. So let's flip up the board and look at inventories, because this is one of the biggest factors. They are now at a lowest level since 1999. One of the reasons for that is that homeowners who bought properties at 4 or 3% mortgage rate, they just don't want to list their apartments or homes and buy something at a 7%. And let's finally flip up the board and look at prices, because this is also a very important factor. Prices are now at the median price for a home is about $416 million US, and this is the second highest price ever. Again, this is because of tight inventories, and also there is a very interesting divergence happening between existing homes and new homes, because for new homes, home builders sometimes they can buy down mortgage rates, and Guy, Bloomberg Intelligence expects that there will be a divergence, and finally, eventually, the market will shift from existing home sales to new home sales.
416,000, I hope. Otherwise, things are getting a little toppy out there. Natalia, nice, really nice. Thank you very much indeed. Perfect setup. Let's talk more about what is happening here. Scott Lawler, Waypoint Residential founder and CEO, joins us now. Waypoint Residential, a real estate investment firm focusing on the U.S. rental housing sector. Scott, let's talk about rental in just a moment. I just want to get your big picture take. Natalia just running us through what's happening with the existing home sales market. It seems to me at the moment we have a cold existing market because of people not wanting to move because of the rates they've got, and a very hot new market. Is anything going to change that breakdown of this market anytime soon? What do we need to have this market get a little bit more balanced?
Well, it's an interesting one because, as you said, tens of millions of American homeowners bought or refinanced at a borrowing cost that's a fraction of today. And so that's a very big deal when you think about moving. So the existing home trading market is